Welcome back to Market on Close. Let's talk some stock picking back into the world of equities on a week in which tech held up the best. Barry Peters joins us, client portfolio manager at Winslow Capital Management. Barry, thanks for being here on a Friday afternoon. We've got big tech holding us together thanks to Broadcom today. Could that revive the semiconductor trade?
I think, as your prior, speakers have commented, the semiconductor trade has to be looked at very specifically, right? It's not a homogenous category where you can bank on all of them benefiting from the AI build out or the data center build out. It's very specific, but yes, in the short term, certainly it's helpful.
So no SMH, no ETF. You guys are picking stocks and growth funds, right? What's the objective? Are you trying to beat just the basic like MAGS fund? Because I'm doing pretty good just parking my money in 7 different names right now.
You're doing pretty good, but I'm sure you're aware how the rules have changed as far as the constitution of the Russell 1000 Growth Index and a permanent cap being put on those MAGS 7
I do, yes.
So the manner in which it's been very difficult as an active manager to keep pace with this index and, heaven forbid, actually think of beating it, particularly if you're running a more diversified approach where these names have constantly mixed up higher, for a number of different factors. First of all, the Russell 1000 Growth Index has gone from 680 names a dozen years ago to 390 today, 394 to be exact, right? So as the number of names in the index have dramatically decreased by more than 40% over the last decade or so, those who are left by default have a bigger exposure. Then you have the index mixing higher as you've had this strong performance from the MAG 7. Then you've had the index being rebalanced with additional weight being added on top of that, which has taken place historically on the third Friday of each June when the Russell 1000 Growth Index is rebalanced. All that's over. It's over. Because starting at the beginning of next year, we're now going to quarterly rebalances, not annually. There's a permanent cap put on those names, the 4.5, what we call the 4.5/45 rule. Any name above 4.5% in the index is going to be permanently capped at 45% cumulatively. So what has been this, virtuous cycle of these MAG 7 names compounding up literally is now permanently capped at a level below where we sit today.
Okay, now how is that going to change for a large cap fund what you're putting in? How does that inform the process?
Yeah, we've really had to adapt with the ever-changing landscape. When we look at our portfolio and how we've looked at it over the course of the last decade or so, as the index has become increasingly concentrated, it's really, we think of it twofold, right? First is you have to think about the MAG 7 almost as if it's a separate portfolio, and then how you want to allocate your capital from a risk-reward perspective across those MAG 7 names. And then separately, you have the remaining roughly 50% of your portfolio that you can decide what you want to do outside of the MAG 7. And I'll be perfectly honest, Oliver, it's been really challenging.
Well, how do you view it as like a new kind of asset class in a way then? I mean, because they don't really have great income characteristics. They're certainly not like a bond or a safety trade. They're not as, we've got crypto for the real wild stuff, as we were talking about in the last convo. Why are they not just exactly what these markets are supposed to do, which is find the best of the best and pay up as much as they ask?
Yeah, well, you pay as much as you ask until, the price mechanism or pricing mechanism changes. It works until it doesn't. And we've all seen lots of experiences over time when it stops working, how painful that can be. But you're absolutely right. Look, the MAG 7 of today is fundamentally different from, let's say, their counterparts 25 years ago as the dot-com bubble was being created. The difference today is these companies are all highly profitable, free cash flow generating machines, many of them in industries where it's become winner take all, right? And then these companies are generating so much free cash flow. If you think about, this landscape 20, 25 years ago or even more, it was the small companies who were disrupting from the bottom up, taking market share and kind of gobbling away at the franchise and the moats of the largest companies. That's really hasn't been the case for some time. Now these large companies really actively seek out anybody who threatens their moat at all and takes them out using their excessive free cash flow at a big premium early in the process, so that their competitors simply become, I guess, the newest features embedded in their business model.
Hey, why no Salesforce in your top 5 or 6 in your funds, Barry? Just real quick as a last thought. I mean, you're in the right place, right time for all this. You're beating the S&P and the growth funds. So all the stuff we're talking about is basically a bull case for these companies. I'm curious, though, who's going to be the gobbler? Is it still going to be Salesforce? Because exactly what you said is what I'm thinking about for what they might be able to do in software.
Yeah, Salesforce, we've owned the vast majority of honestly, the last decade. We recently sold them following their most recent quarter. As, again, one of your prior speakers noted, the capital expenditure cycle is kind of a zero-sum game, right? You can't spend the same dollar twice. You can't spend the same dollar in 2 different places. And disproportionately, the Capex cycle near term has favored, names like NVIDIA in the semiconductor space, and has kind of in the near term come at the expense of some of the SaaS names like Salesforce. So we exited Salesforce. We stepped aside for the time being, but I can absolutely see us coming back. They're the perfect example right now of what we're seeing, the profit productivity that's being driven across large cap tech land and across corporate America more broadly. Salesforce's operating margins have expanded 50%.
Wow, that's incredible. That's amazing.
50%.
Great stat. Hey, Barry, thank you very much for your time. Fun chat.